However, its losses are potentially unlimited. These non-linear payoffs are fascinating as they lend themselves to be used to generate various payoff by using combinations of options and the underlying. So let us see one by one. The first one is buyer of call position. The buyer of an equity call position has purchased the right but not the obligation to buy, uh, for example, 100 shares of underlying stock at a stated exercise price at any time before the option expires. Once the option is purchased, the buyer is then long the call contract, and to purchase underlying shares, he notifies his brokerage firm of his intent to exercise the call contract. For example, the buyer of one XYZ June 60 call option has the right to purchase 100 shares of XY stock at 60 per share up until the June expiration. So here you can see the potential profit is unlimited as the underlying stock price increases. As the underlying stock price increases, the potential profit is unlimited, whereas the potential loss is limited to the premium paid for the call option. The second is a writer, that is seller of call option. So an investor who sells an option contract that he does not already owns is known as the option writer, and he then shorts the contract. The writer of an equity call option, commonly referred to as the seller, has the obligation to sell 100 shares of underlying stock at the stated price if assigned an excise notice at time before the expiration expires. So here the potential profit is limited to the premium received from the calls, that is initial sale, whereas potential loss is unlimited as the underlying stock price increases. So next is a buyer of a put option. So a put option gives the holder the right to sell an asset at certain price within a specific period of time. So puts are very similar to having a short position on stock. Buyers of put hope that the price of stock will fall before the option expires. The buyer of an equity put option has purchased the right but not the obligation. For example, to sell 100 shares of the underlying stock at a stated exercise price at any time before the option expires. Once the option is purchased, the buyer is then long the put contract, and to sell 100 underlying shares, he notifies his brokerage firm of his intent to exercise the put contract. Next is the writer, seller of a put contract. So in buyer of a put option, we can see that the potential profit is substantially and increases as the underlying stock price decreases to zero. The potential loss is limited to the premium paid for the put. So writer, otherwise seller of put option. An investor who sells an option contract that he does not already owns is known as option writer and then shorts the contract. The writer of an equity put option, commonly referred to as the seller, has the obligation to purchase 100 shares of an underlying stock at the stated excise price if assigned an excise notice at any time before the option expires. So here the potential profit is limited to premium received from puts initial sale, but the potential loss is substantially and increases as the underlying stock price decreases to zero. So option are most flexible all types of derivatives because they give an option holder a multiple choice at various moments during the lifetime of option contract. However, option seller does not have such flexibility and always has to fulfill the option holder's request. For this reason, the option buyer has to pay a premium to the option seller. So next is the hedging strategies which are used in option. So we have three types of strategies which are used in option. First one is bullish, second is bearish, and the third is neutral strategy. So an option strategy combines one or more option position and a zero or more underlying positions. The option position used are almost always long and or short position in calls and or puts at various strikes. Choosing the right option strategy is one of the most difficult decision of an investor. The best strategy is one that directly matches the investor's set of risk and reward expectations with the possible movement of underlying asset. Option can be used for a wide range of strategies and each of these strategies has a different risk reward profile. Combining any of the above said option call off, it is possible for us to make different types of option strategies. Simple strategies usually combine only few trades while more complicated strategies can combine several. Uh, Generally, an option based hedging strategies involves the simultaneous purchases and sale of different option contract. It is also known as option combination. So, as there are three types of option strategy. First one is bullish, second is bearish, and the third is neutral. So, in bullish, we have seven kinds. So, the first one is long call, otherwise called as buy call. This is otherwise called as buy call. So a long call is simply the purchases of one call option. A long call option is the simplest way to benefit if we believe that the market will make an upward move and is the most common choice among the first time investor. Being a long a call option means that we will benefit if the stock future rallies. However, our risk is limited on the downside if the market makes a correction. So a long call has a unlimited profit potential on the upside. So the maximum loss is limited to the premium paid up front for the option. The maximum gain is unlimited as the market rallies. So when to use this long call? When we are bullish on market direction and also bullish on market volatility. So upside potential, the price of the option increases as the price of an underlying rises. You can book profit by selling the same option at higher price whenever you think that the underlying price has come to the level you expected. And downside risk is limited to the premium which you have paid. Maximum you can lose is the premium in long call. The second is short put. A short put is simply the sale of a put option. Like the short call option, selling a puts can be a very risky strategy as our losses are unlimited in falling market. The return put can provide the investor with extra income premium received on put option in a stable to rising market. Most investors use this strategy as the method of buying stock at cheaper rate. Short put is used when the investor expects the share price index to remain steady or be slightly bullish over the life of the option. So the maximum loss is unlimited in the falling market. Maximum gain, it is limited to the premium which is received by selling the put option. So when to use this? When we are bullish on market direction and bearish on market volatility. The third is covered call. This is the result of a long underlying asset and short call options. This strategy is used by many investors who hold stock. It uh, It is also used by many large funds as a method of generating consistent income from the sold options. The idea behind a covered call is to hold stock over a long period of time and every month or so sell out the money call options, even though it has an unlimited loss potential. So the maximum loss is unlimited on the downside. Maximum gain limited to the premium received from the sale of call option. So when to use this? When we own the underlying stock and wish to lock in the profit. And the fourth one is a protective put. This is the result of long the underlying asset and long put options. A protective put strategy has a very similar payoff profile to the long call. The maximum loss is limited to the premium paid for the option, and we have an unlimited profit potential. So, protective puts are ideal for investors who are very risk averse. They hold stock and are concerned about a stock market correction. So if the market does sell off rapidly, the value of the put option that the trader holds will increase while the value of the stock will decrease. If the combined position is hedged, then the profit of the put option will offset the loss of the stock and all the investors will lose the premium paid. However, if the market rises substantially past the exercise price of the put option, then the put option will expire worthless while the stock position increases. But the loss of the put option is limited while the profit gained from the increase in the stock position are unlimited. So, maximum loss limited to the premium paid for the put option. Maximum gain unlimited as the market rallies. That rallies in the sense it rises. When to use? When the investor is a long stock and wants to protect against the market correction. Next is options spread strategies. Option spread means taking a position in two or more options of the same type, either call or put on the same underlying asset, that may be share or index. In other words, an option spread trading strategy involves taking a position in two or more option of the same type, that is two or more call or two or more puts having the same expiration date but different exercise prices. So option spread may be classified under three categories: vertical spread, horizontal spread, and diagonal spread. Vertical spread, this is the option spread made by the combination of options having different strike price but the same expiration date. Horizontal spread, unlike vertical spread, these strategies involves taking option position in similar options, either call or put, having different expiration dates but the same strike price. Diagonal spread. A diagonal option spread is made when the investor takes position in option of the same type with different strike price and different expiration date. So a bull spread that is designed to profit if the price goes up is called a bull spread. These are at times when the investor thinks that the market is going to rise over the next 2 months. However, in the event that the market does not rise, he would like to limit his downside. One way you could do this by entering into a spread. The buyer of the bull spread buys a call when an exercise price below the current index level and sells a call option when the exercise price above the current index level. The spread is a uh, the spread is a bull spread because the trader hopes a profit from a rise in the index. The trader is spread because the trade is spread because it involves buying one option and selling a related option. So we can have three types of bull spread. Type 1, both call initially out of the money. Type 2, one call initially in the money and one call initially out of the money. Type 3, both calls initially in the money. Next is call bull spread. This is a result of a long one call option with a low strike price and short one call option with a higher strike price. A call spread, also called a bull spread, comprises a long call at one strike price and short call at higher strike price. Both options are of the same expiration. A call spread is an inexpensive alternative to simply buying a call. It has limited upside potential, but income from selling the high strike call offset the cost of purchasing the low strike call. So the maximum loss is limited to the premium paid, whereas the maximum gain limited to the difference between the two strike prices minus the net premium paid for the spread. So when to use this? When we are mildly bullish on the market price and or volatility. Next is put bull spread. This is a result of a long one put option and short another put option with a higher strike price. A put bull spread has the same payoff as the call bull spread, except, except the contract used or put option instead of call option. Even though bullish, a trader may decide to place a put spread instead of a call spread because the risk reward profile may be more favorable. And this may be in the case if the in the money call option has have a higher implied volatility other than the out the money put options. In this case, a call spread would be more expensive to initiate, and hence the trader might prefer a lower cost option of a put spread. The maximum loss is limited to the difference between the two strike price minus the net premium received for the position, whereas the maximum gain is limited to the net credit received from for the spread. So when we can use this when we are bullish on market direction. The last seventh one is straps. If the investor expects that the big price change would occur in the stock price, but feels that there is relatively greater possibility of increase in price, bullish, then decrease in price, then the investor would consider the strategy of straps. A strap consists of a long position in two calls and one put with the same exercise price and expiration date. The profit and loss profile under strap will be adjusted. The next is bearish strategy, in which we have five categories. The first one is short call. A short call is simply the sale of one call option. A selling option is also known as writing an option. A short is also known as a naked call. A naked call are considered very risky position because our risk is unlimited. So maximum loss unlimited as the market rises, maximum gain limited to the premium received for selling the option. So when we can use this? When we are bearish on the market direction and also bearish on market volatility. So next is a long put. A long put is simply the purchases of one put option, like the long call. A long put is a nice simple way to take a position on the market direction without risking everything. Except with the put option, we want the market to decrease in value. Buying a put option is a fantastic way to profit from a downturning market without shorting stock. Even though both method will make money, the market sell off. Buying put option can do with limited risk. So when we are bearish, buy a put option. When you are very bearish on a market as a whole, buy a put option on indices. When you are very bearish on a particular stock, buy a put option on that stock. The more bearish you are, the more out of the money. Lower strike price should be the option you buy. So no other position gives you as much leverage advantage in a falling market in the limited downside. So the maximum loss limited to the net premium paid for the option, whereas the maximum gain unlimited as the market sells off. So when we can use this is when we are bearish on a market direction and bullish on market volatility. The next is call bear spread. A spread that is designed to profit if the price goes down during the bear phase in the stock market is called bear spread. The buyer of the bear spread buys a call with an exercise price above the current index level and sells a call option with an exercise price below the current index level. So a call bear option spread is formed by short one call option with the lower strike price and long one call option with the higher strike price. A bear spread can also be created by buying a put with a high strike price and selling a put with a low strike price. A call bear spread is usually a credit spread. A credit spread is where the net cost of the position result in the investors receiving money upfront for the trade. We sell one call option and buy one call option. The net effect is called as credit. The maximum loss is limited to the difference between these two strike minus the net premium. Maximum gain limited to the net premium received for the position. Next is put bear spread. This is formed by short one put option at a lower strike price and long one put option at a higher strike price. A put bear spread has the same payoff as the call bear spread, as both strategies hope for a decrease in the market price. The choice as to which spread to use, however, comes down to risk reward. So the maximum loss is limited to the net amount paid for the spreads. That is the premium which is paid for the spreads. Maximum gain is also limited to the difference between these two strike prices. The fifth one is strips. Strips are option trading strategy which is used when the investor is expecting that there would be a big price change in the stock price, as a result of which the price would relatively decrease more than increase, thus affecting the bearish trend. A strip is that option combination where a long position in one call is joined with a long position in two puts with the same exercise price and the date of expiration. The profit loss pattern for the strips will be adjusted on the expiration date. So next is the neutral strategies. In neutral option trading strategies denotes that the option combination which are used by investors when there is no clear distinct direction expectation of price movement of an underlying asset. This means that the price cannot be expected to be bullish or bearish and may either witness stable price structure or more volatile fluctuation in either direction. So there are 14 neutral option strategies as listed below. That is long straddle, short straddle, long stangle, short stangle, call time spread, put time spread, call ratio vertical spread, put ratio vertical spread, long call butterfly, short call butterfly, long put butterfly, short put butterfly, box spread, counter spread. So, what is this straddle? In finance, a straddle is an investment strategy which involves the purchases or sale of a particular option derivatives that allows the holder to profit based on the magnitude of price movement in the underlying securities, regardless of the direction of price movement. Straddle is an appropriate strategy for an investor who expects a large move in the index but does not know in which direction the move will be. This involves the simultaneous holding of the two following questions: buy call option on index at a strike K and maturity T, and buy put option on the index at the same strike K and maturity T. So with this bullish strategy and bearish strategy, we will end up our class today, and we will continue our class with neutral strategy and how to value the options in our next class. Any questions? Yeah, I will share the videos in your Google Classroom. No, actually, the strategy is what we are going to avoid the profit. We are combining the options, one option and another option, and we are trying to minimize the loss and maximize the profit. So that is what we call it as the strategy. So bullish is a place where we are expecting the rise in price of the underlying, whereas bearish is a place where we are expecting that the price will fall down. So neutral is a place where we don't know whether it is going to rise or it is going to fall down. So that is why in neutral we have 14 types of strategies which we will be using in options. Okay, thank you. Yeah, you have assignment to. Yes, Richard. Yes. Yeah, today's class will be loaded in Google Classroom. Okay. Yeah, I think I shared two texts